Okay, we're going to look at stop losses. I think the first thing about stop losses is that they are completely overrated in terms of risk management. It is as if you just add stop losses to what you do, all your problems, all your potential risks evaporate. There are much more to risk management than how to address stop losses. One of the most important aspects in stop losses is the missing link, and that is that when you apply a stop loss, you should actually apply it to stop further losses. And it is very difficult in the very short-term trading environment to determine if what you're going to have next is actually further and real losses. Because in a very short-term trading environment, prices move basically up and down quite randomly and completely unpredictably. Another issue with stop losses that which everybody, experience, or a lot of people experience, and that's the big complaint. The stop losses get hit too often because the stop losses are placed too close to the entry. And as a result, people complain the whole time that they have bad luck, because just after their stop was taken out, the market went into their direction. Stop losses usually make or is discussed in terms of risk-reward ratios. Now, unfortunately, we're going to run out of time, and I cannot spend a lot of time on the issues about what I call unscientific risk-reward ratios. But it is basically about the following. If you want to determine a risk-reward ratio that actually works on a specific trading strategy, you need to have a huge amount of data that proves that a risk-reward ratio of 2-to-1 or 3-to-1 or 4-to-1 or whatever this risk-reward ratio is, that is actually a scientific risk-reward ratio, and that if you apply that specific strategy, you are in the long run going to benefit from the fact that you have more losses than wins. I think one of the problems why most beginners and not successful traders in the long run, one of the problems they have is that they just never get to a real scientific risk-reward ratio, and they go to something new. They go to a next system that they try, and then this and then that. And in many cases, they do not take all the trades that the system offer, and that affects the risk-reward in any case. So unscientific risk-reward approaches is one of the reasons why stop losses simply cause more losses than stop losses. Unscientific percentage of risk, we've touched on that. Most people it's just a thumb-suck number. No, they read somewhere something about the 2% or 3%, don't risk more than 2% of your account. Combined with the unscientific risk-reward ratio, most people never really test these things, and they just believe it, and they try something, and hopefully it will work. Well, unfortunately, it doesn't work for many traders. Aspect of stop losses that is problematic, and where people apply the concept of market risk, things immediately go better. And in very practical sense, if you only look at, oh, this is my account and this is my leverage, and I use 2% stop loss on any trade, and I trade on 5-minute or 15-minute charts, and you ignore the fact that, well, there's basically only one market, and you look at that one market either through a 5-minute or a 15-minute or a 1 hour or a daily scale. The fact that you use a specific chart interval does not change the market. The market and the risk in the market is something that you cannot just ignore. You cannot make as if the market is something that exists in a 5-minute time interval and not on a much longer scale. There are many other market participants that move the market probably in much bigger ranges than a private trader with a small leverage account can contemplate. So you cannot ignore market risk. And that is why stop losses go wrong. Because people believe that there's a trend on a 5-minute chart on an intraday level, and they put some stop loss there, but they ignore the market risk that 5-minute chart does not represent the market. The market is what happens if you stand way back and look at everything and what everybody does. So do not ignore market risk. But if you then, for instance, apply this and think what other people do and put stop losses where the market would have exhausted itself in a certain run, either intraday or intra-week, or in what time frame you are comfortable with your trading. If the market has exhausted itself, then a stop loss might be much more profitable. Okay, the next concept about stop losses that you have to understand. Stop losses increase uncertainty. Now, everything people say about trading psychology, I believe, miss the point. It's not about fear and greed. It's about uncertainty. And if you doubt this, well, there are some interesting stuff that you can read about the impact and the role of uncertainty in our lives and how our brains struggle to handle the concept of uncertainty. And the problem with stop losses is that they increase uncertainty.